What's up guys, hi, this is Madhav here, and in this video I'm going to teach you an options strategy for expiry that can make 3 to 10% returns in one day. So let's start. Get instant access to my weekly market updates in which I post what the market might do for the next week by hitting the subscribe button. So before we move on to the strategy, I would like to first explain the factors that affect option prices. So there are three factors. The first is change in price, second is volatility, and third is time decay. The first factor denotes the change in option price with respect to change in the underlying. Volatility increases when a lot of people trade a particular script. An increase in volatility usually increases the option price. And the third one, which is time decay increases as we move towards expiry. In this strategy, we'll be selling options, therefore time decay will be extremely helpful to us. If you are bullish on any stock, then you have two options. You can either buy a call option or you can short a put option. And if you are bearish on a stock, then you can buy a put option or you can short a call option. Our strategy will mainly revolve around shorting options. We'll only be shorting either a put option or we'll be shorting a call option. Basis of the strategy is after a breakout, a stock usually returns back to its average daily range. So consider for example a stock which moves 4 to 5 rupees every day, but suddenly it jumps 10 to 15 rupees, which is very unusual. So at that time, what we do is we short an out of the money call option. What the stock tries to do is it tries to return to its original range, which is 4 to 5 rupees. The stock won't continually be moving in a range of 10 to 15 rupees from today, but it will again return back to its previous range, which was 4 to 5 rupees. So we take advantage of such a move in such a way that when the prices cross the daily range, we short an out of the money call option or a put option. The steps involved in this strategy are: first is we find the stock which is showing maximum movement in the morning. Why in the morning? Because in the morning the markets are very active and the volatility tends to be high. So as afternoon progresses, volatility decreases. Because we are shorting options, the premium will also decrease. The second step is check if the stock options are liquid. So if you're trading in a stock option, always check if the stock option is liquid. So what does liquidity mean? Liquidity means that there should be a buyer who is willing to buy from you at a reasonable price. Third point is calculate average range and volatility. I'll show you how to calculate these two things. And the final is selecting a proper strike price and then shorting the option. Let's start with the first step. Find the stock showing maximum movement in the morning. For that, you need to go to nseindia.com. Over live market, click on equity stock and change the option to FO stocks. So this will include all stocks of which contract options are available. Click on percentage change to see which stock has moved heavily in the morning. Right now, we can see Havells, Distivi and Zeal. These three stocks have given a huge movement today in the bearish side. Usually when a stock is moving on the bearish side, I do not short put options over there because fear and panic can lead the stock price to fall to any levels. So I do not want to take a risk on the long side. I want to take a risk on the short side. So I want to look for any stock showing upward momentum. Right now we can see SRE Infra, Union Bank and Page Industries have shown a good movement today. The second step is check if the stock options are liquid. How you can check this? Again, go to nsaindia.com, hover over live markets and click on equity derivatives under option chain. You'll find the list of the options over here. Let's first search SRE Infra. So as you can see, the total volume in SRE Infra is 209 on the call side. For me, 209 is a low volume. Let's see Union Bank. So Union Bank has got a volume of 630, which is a good volume, and the options in the stock are liquid too. I'll choose Union Bank over here. Third step is to calculate average range and volatility. So to calculate the average range of the stock, I need to get the historical data of that particular stock over the last year or the last 2 years. Go to products. Under products, click on equities. Under equities, go to historical data, and under historical data, go to security wise price volume archives. Over here, type Union Bank. Select the series as EQ, which is equity, for the past 1 year. Get data. This is the data for Union Bank for the past year. You can simply download this data by clicking over here. Once you download the data, delete these 5 rows. Just type in range over here. and volatility. What exactly is range? Range can be said as closing price of today as compared to that of yesterday. So over here you can write the formula as today's closing minus yesterday's closing, but it will give you a negative value. So type in absolute over here so that you get just the magnitude of the range. So this will give me the value, and if I want a percentage, I just type in divided by yesterday's closing price into 100. So this gives me the range. What do you mean by volatility? Volatility means the difference between the highest and the lowest prices achieved on the same day. You can calculate this by subtracting the lowest price of the day from the highest price of the day, dividing that by the lowest price of the day into 100. This will give me the percentage. So just now after applying these values to the whole file, just copy this data and paste it on a new Excel sheet. Once you paste the data over here, you can see a small paste option over here. Click on paste values. So once you paste the values over here, apply a filter and sort the range tab. So as you can see, the highest value that the stock can move up to is 12% as compared to the previous day. Yesterday's closing price of Union Bank was 94 rupees. So the maximum the stock can move to is 12% of 95 rupees, which will be 11.4 rupees. So adding that to 95, I'm not expecting the stock to move above 106. This I'm saying from the last 1 year's history. So the stock is shooting up to 95, then what I can do is safely short 107.5 call option and back the premium on the expiry day. If you guys want to play a bit riskier, then what you guys can do is take the average of 10 highest counts. The average comes out to be 8.2. 8% of 95 would be 7.6. Add 95 to that, that comes out to be 102.6. So for Union Bank, I can either short 107.5 option or I can short 102.5 call option. So right now the premium is high because we are very far away from expiry. But usually when such a move occurs, the premium also goes up despite this being a deep out of the money option. The next thing over here is volatility. If you sort the volatility from the largest to smallest, you can see that the stock has moved 19 rupees from its lowest price on a single day. Even if this volatility crosses the average, which is 12.6, if the stock has been up around 12.6 rupees from the lowest point on that day, then you can consider it a bit safe to short a call option. We are also done with the fourth steps, that is selecting a proper strike price. Once you short the call option, you can wait till expiry for the call option to expire and back the whole premium. Or what you can do is buy the option at a very small price, which is 5 paise, just a minute or two before 3:30. Some points to consider to use this strategy are always short at a resistance level. If you're shorting Union Bank at 102.5, then another confluence for this would be to make sure that there is a resistance level present around 100 levels, which will be an added advantage for you. And the second is short a slightly deeper OTM option to stay on the safer side of the trade. So the more deeper you go, that is, if you short 107.5 option instead of the 102.5 call option, then you will get a slightly lesser premium, but the trade will be a lot safer. Advantage of the strategy are you get a higher premium in spite of the day being an expiry day, because if a stock is shooting up 4 to 5% on a particular day, then volatility will increase, which will increase the premium of the option. Second, no overnight risk. You need not carry the option another day because that will be the last day of that contract. Relatively safe returns because this will happen from the morning around 10 a.m. to 3:30 p.m. Time decay is maximum on the last day of expiry, so time decay will help you a lot. I have mentioned the strategy as a single day. You can also tweak the strategy and try it out for a week or the last week of expiry because the time decay is high for the whole last week of expiry. If you're playing this for the whole last week of expiry, then you'll also get to bag a bigger premium. And just keep one thing in mind: when you're calculating the average range, go for the weekly range and not the daily range. Let's look at the returns the strategy can give. So this is a margin calculator over here. Click on options, symbol Union Bank, call option, strike price 102.5, sell. So this will give me a premium of 4,900 rupees on an investment of 87,000 rupees. So let's see how much does that come to. 4,900 by 87,000. So this comes out to approximately 5% returns in a single day. I usually get 3% returns using this strategy. Considering the minimum 3%, if you use this strategy on each and every month, then you can easily make a return of 36% in a year using this one strategy for a single lot on a single day. I hope you guys like the strategy. If you guys have any doubts regarding the strategy, then please drop your doubts in the comment section below and I'll answer them. Thank you for watching this video.